Advocate Pratik Gupta, Partner Sharnam Legal, Mr. Shashi Matthew, Partner CMA Indus Law, Mr. Brijesh Kothari, Partner Khitan and Company. Mr. Pratik Gupta is a distinguished advocate and GST law expert with extensive experience in indirect taxation, GST litigation, advisory, and regulatory matters. He regularly advises businesses on complex GST issues and has represented clients before various judicial and quasi judicial forums. His practical and solution oriented approach has earned himself recognition as a trusted advisor to the business across industry. Mr. Shashi Matthew is an accomplished indirect tax professional associated with CMA Indus Law. He has extensive experience in GST advisory, compliance, tax restructuring, and policy interpretation, advising leading India's and multinational companies across diverse sectors. He is widely respected for translating complex tax issues into practical business solutions. Mr. Brijesh Kothari is a partner at Khitan and Co. and one of the India's leading expert in indirect taxation. He advised domestic and multinational businesses on GST strategy, tax disputes, litigation, and regulatory matters. We extend our sincere gratitude to all our esteemed speakers for sparing their valuable time and sharing their knowledge and expertise with ISFA community. During the webinar, I encourage all the participants to actively engage with our speaker by posting your queries and questions in a Q&A section only. We will make every effort to address as many questions or queries as possible during the interactive discussions. I am confident that today's deliberation will provide valuable insights into the achievements of GST over the last 9 years, examine the challenges that businesses continue to face, and offer practical guidance on the road ahead. Thank you very much. Now, it is my privilege to invite our first speaker, Advocate Pratik Gupta, Partner Sharnam and Legal, to share his insights on today's theme. Sir, the virtual platform is yours.
Good afternoon, everyone. Thank you, Akshat, and thank you, ISFA, for having me. My name is Pradeep Gupta. I'm the managing partner at Sharnam Legal. And for next 30 minutes, I want to talk about something that touches every single GST registered business in this room. Whether you are an SME or an MSME, a franchisee, operator, or a tax professional, we are 9 years into GST. ITC is no longer a new concept, but it remains the hand and heart, the single most litigated and most misunderstood and most cash flow critical piece of GST machinery. Today, I'll walk you through three things. First, your rights, what law actually entitles you to claim. Second, the restrictions, where the right gets narrowed, time barred, or reversed. And third, the road ahead, where this all is heading, including some very recent developments from last few months. I'll keep this discussion practical for the business owners in the room, and I'll flag the section numbers and case citations for the professionals. A quick map so you know where we are headed. 6 stops. Why ITC discipline, your rights under section 16, restrictions, time limits, and matching rules, litigation lines, where I'll walk through how courts are treating section 16 too, including judgments from as recently as this year. Practical pitfalls I see MSME and MSME taxpayers make, and finally the road ahead, ending with the one-page checklist. You can literally screenshot of this slide at the end and keep in your phone. Let's start with why this still matters even after 9 years of GST law. GST entire design philosophy rests on one idea. Tax should only be levied on the value added, not on full price at every stage. Input tax credit is the mechanical device that makes it happen. Without ITC working smoothly, GST is just a very complicated cascading sales tax. Now, why I'm spending time on this at a 9 year after 9 years of GST in this webinar, when ITC is not a new topic, because the ITC ecosystem has changed dramatically in the last few years. The old system had cushion. Rule 36, subclause 4, allowed you to take a percentage provisional credit even if the supplier had not uploaded his invoice. That cushion is gone since January 2022. Today, ITC is most mechanically tied to what shows up in your 2B. At the same time, we are seeing a strange collision. On the one hand, the government has granted retrospective relief for old financial year 2017 to 2021 disputes through new section 16.5 and section 16.6. On the other hand, the appellate tribunal has become operational this year in February 2026 after an 8-year wait, and now is absorbing 4 lakh plus pending appeals, most of which involves the issue of ITC. For an SME or MSME, all of this is an academic. ITC is working capital. A blocked or a delayed credit is real cash sitting with the government instead of it in your bank account. That is why discipline around ITC is more important now than it had ever been. This is the foundation slide, and I have deliberately made it exhaustive for your easy understanding and adoption in business. Section 16.2 today has 6 limbs, not 4. The law has been amended twice since 2022 to tighten it further. Clause A of Section 16, a valid tax invoice or a debit note is required. Clause AA, inserted with effect from 1st January 2022. The supplier must have actually furnished the invoice in their GSTR1 and it must be communicated to you in your 2B. This is the clause that operationalizes GSTR 2B matching as a matter of statute, not just a procedure. Clause B of Section 16, actual receipt of goods or services, including the bill to, ship to, deeming fiction. Clause BA of Section 16, inserted with effect from 1st October 2022. The ITC communicated to you must not have been restricted under Section 38 in practice. This is invoice management system where you or the system can flag or restrict certain invoices. And if it is restricted, you cannot claim it. Clause C, the tax must have been actually paid to the government by the supplier, subject to Section 41. And this is most litigated area when we talk about ITC. And clause D, you must have filed your own 3B under Section 39. One more thing tucked into Section 16 that's easy to miss. Subsection 3 says if you have claimed income tax depreciation on the GST component of a capital asset, you cannot also claim ITC on the same component. You have to pick one, depreciation on the tax component or the ITC. It cannot be both. I see this mistake in a newly incorporated SME or MSME more than anywhere else. Now, having ticked all 6 boxes under Section 16, subclause 2, don't assume you have done everything. Section 17, subclause 5 is a separate absolute bar, a list of block credits that can never be claimed regardless of genuine business use. I want to flag upfront this list itself have been amended twice recently. So if you have learned the old list, you must forget it and you must learn the new list now. On the eligible side, general inputs, capital goods, and input services used for business are claimable. Motor vehicles are eligible only in specific use cases. For further supply, passenger transport as service or driving training school can take ITC on motor vehicles. Food and beverages and health insurance become eligible only if you are obligated under any law to provide them to your employees, or you are dealing in the same category of service. Work contract for plant and machinery as opposed to general immovable property remains eligible. On the block side, motor vehicles, vessel, and aircraft for general use. And a note, their insurance, servicing, and repair is block 2. That's a distinct clause many people miss. Food, beverages, club membership, rent-a-cab, employee vacation travel, all is blocked unless legally obligated. Own account construction of your office or warehouse, blocked even though it's a genuine business expense. Two amendments I want to specifically flag because they are recent and commonly missed. First, CSR expenditure. If your company spends on corporate social responsibility under the Companies Act, ITC on the spend has been blocked since Finance Act 2023. Second, this and this is favorable change. The old blanket block on the tax paid under Section 74, 129, and Section 130, fraud, detention, and confiscation, has been now narrowed. Since 1st November 2024, only tax paid under Section 74 and only for periods financial year 2023 to 2024 remains blocked. Tax paid under Section 129 and Section 130 is no longer on the blocked list. And this is because the law itself restructured the fraud versus non-fraud demand framework going forward. The practical takeaway for business owners before you claim ITC on any big ticket item, a car, building, CSR donation, a club membership, stop and check this list first and check if the current version of it and not the old one. ITC eligibility follow in practice. I put this flowchart because I want every business owner in this room to have a mental checklist they can run through before claiming any ITC. Not just an year-end audit time. 6 questions you must have in your mind while you are checking the eligibility of ITC. In this order, do I have a valid tax invoice? Did I actually receive the goods or services? Has the supplier reported it? And does it show up in my GSTR 2B? Because if it does not, don't claim it yet. Has it been restricted through the invoice management system under Section 38? If IMS has flagged or restricted it, it is not available to you. It is on the block list under Section 17.5. And finally, if I am within the time window under Section 16.4, or does the new Section 16.5 rescue the old claim? If everything is a yes and nothing is blocked, you can claim it through your GSTR 3B and it lands in your electronic credit ledger. If any single answer is no, the credit is either deferred. If it is just a timing mismatch, that resolves when the supplier rectifies his return. If not, then it is permanently lost. If it is blocked or time barred. I'll say this clearly. This is a simplified self-check for routine day-to-day purchase. For anything high value or contested, a big capital asset, an ongoing dispute, a related party transaction, please get a proper legal advice. This slide is not suitable for that. 2 restrictions that together may cause more ITC loss for an SME or MSME than anything else. First, the matching mechanism. Under old Rule 36, subclause 4, even if your supplier had not uploaded an invoice, you could provisionally claim the ITC. This provisional claim of ITC was available till 1st January 2022 on a percentage of it. It started with 20%, came down to 10%, and then 5%, which has been removed entirely now. Your ITC is available strictly to the extent it appears in your 2B. Nothing more. Circular 170 of 2022 also requires you to separately disclose the eligible ITC in table 4 of GSTR 3B. So the department can see exactly what you are excluding and why you are excluding. The practical effect is uncomfortable, but important to internalize. Your ITC is now hostage to your vendor GST compliance. If your supplier is filing GSTR 1 late, your credit is delayed. If they never file it, your credit never came to you. Second, Section 16, subclause 4, the time limit to claim ITC. You must claim ITC on the invoice before 30th November following the end of financial year. This is treated as hard, substantive cutoff, not merely procedural formality as courts have repeatedly held. Here's a trap I often see. If you file your GSTR 9 early, say in September, you may accidentally close your ITC window 2 months earlier than 30th November. Always reconcile everything before you file your annual return. In 53rd meeting of GST Council recommended fixing a long-standing hardship faced by thousands of business had ITC denied purely because of Section 16(4) limitation of claiming of ITC. There has been a relaxation for financial years 2017-18 to 2020-21. This is an unusual retrospective amendment which was made in favor of the taxpayer. This is very rare in Indian tax laws that a favorable tax amendment is made. The new subsection in Section 16 both made retrospective effect from 1st July, the very start of GST. Section 16 subclause 5 is for financial year 2017-18 to 2020 to 2021. If you claimed ITC in any 3B filed on or before 30th November 2021, that claim is valid, regardless of when the limitation period under Section 16 subclause 4 would otherwise have expired. Many taxpayers have already missed the timeline to file rectification application. They would need to pursue this through appeal mechanism. Section 16(6) deals with narrower but real problem. Business whose registration was cancelled under Section 29, sometimes wrongly or on technical grounds, and later revoked by the department. The rule is only to help if the ITC was already time barred under Section 16(4) as of the cancellation date, and the claim window is later of 2 dates. Either you are within the normal limitation of Section 16(4) deadline or 30 days from the revocation order, whichever gives you more time. So if your registration is restored quickly, you still get the benefit of later deadline. Now, 5 reversal and blocking triggers that can catch business off guard. Usually during departmental audit, Rule 42 covers inputs and input services used partly for taxable and partly for exempt supplies or personal use. Reconciled annually by September of the following year with interest if you are under reversed. Rule 43 does the same for capital goods, spread over 5 years, 60 months useful life. In case you make a sale of these capital goods before the period of 60 months, then you need to check that is there any implication of reversal of ITC. Rule 37 is the 180-day payment rule. Unpaid supplier beyond 180 days means that you need to reverse the ITC with interest and claim it once you pay the supplier. Useful nuisance for the professionals. Rule 37 subclause 4 says Section 16(4) time limit does not apply when you reavail credit that was reversed and later restored. So you're not on time barred on reclaim ITC itself. Now Rule 37A. And I specifically want to spend time here because it is the rule that sits directly behind Sunscraft and Bethel litigation. I'll come over to next in my next slides. Rule 37A says, even if the supplier correctly reported the invoice in their GSTR1, if they don't go and file their own GSTR 3B and actually pay that tax by the 30th of September following the next financial year, you, the recipient, must reverse the ITC in your 3B by 30th of November with interest if you are late. The good news is that it's not permanent. Once your supplier eventually files, you can reclaim it. But the notice, what does this mean? Even a technically correct, fully documented ITC can be clawed back purely because your vendor didn't pay months or years after you claimed it. And Rule 86A. This is the one that keeps business owners up at night. It lets a tax officer provisionally block your electronic credit ledger merely on reason to believe that the credit is fraudulently availed or ineligible before any show cause notice or adjudication. It is increasingly used in fake invoicing cases, which brings us to next litigation portion of today's talk. Let's look at 2 competing lines of authority because that's more honest picture than treating this as simpler buyer always wins story. On the left, the cases that protect bona fide buyer, Suncraft Energy is the flagship, the Calcutta High Court Division Bench judgment of August 2023, that the department cannot reverse a buyer's ITC merely because supplier didn't reflect that invoice in his GSTR 1, or it does not reflect in GSTR 2A of the recipient. It must first proceed against the defaulting supplier. That is what the Calcutta High Court has held in Suncraft Energy. That in case your supplier defaults, then first the department must move towards the supplier to get the legally collected amount of GST deposited, since he is an agent of the government. And then only if he doesn't pay that amount, then only the proceedings should move towards the recipient of that such goods or services. This decision of Suncraft has also been appealed by the department before the Honorable Supreme Court. The Supreme Court has not entered into the merits of this judgment of the Honorable Calcutta High Court and have dismissed the SLP. Thus, this decision is final as on today. This decision is also heavily relied by the Supreme Court's own Bharti Airtel judgment and Delhi High Court Arise India ruling. DI Bethel Enterprises from the Madras High Court adds natural justice angle, recovering only from the buyer without even examining the seller as a witness in a fundamental flaw. But here's the honest counterweight, and I think professionals in the room especially need to hear this. Ecom Guild Trading, decided by the Honorable Supreme Court in March 2023, a VAT case, but its reasoning is regularly imported into GST disputes by revenue authorities. The court held that the burden of proving an ITC claim rests squarely on the purchasing dealer, and that the burden does not shift onto the department. Merely producing an invoice and showing payment by check is not enough. You need to show the actual physical movement of goods. Who transported the goods, in which vehicle the goods were transported, freight payment records, delivery acknowledgements. This is generally tough standard. And I have seen assessing officers cite Ecom Guild specifically to reject ITC claims that would otherwise look clean on paper. So reconciling principle, I would leave you with good faith protection under Suncraft and Bethel shields you from being punished for someone else default. Once the genuineness of your own transaction is established, it does not excuse you from actually proving that genuineness in the first place. Keep your transportation documents, delivery records, and vehicle details, not just invoices and bank statements. Four judgments I would like to ponder upon. Cargo Traders, the Calcutta High Court in June 2023, a close cousin of Suncraft pattern. But here the department ground was that supplier registration was cancelled with retrospective effect. The court found that the buyer had genuinely verified the supplier's valid registration at the time of transaction and paid through bank, and held authority must reconcile the matter on actual documents rather than lean solely on the retrospective cancellation aspect. Solvi Enterprises from Allahabad High Court, a March 2025 decision, where proceedings under Section 74, the fraud provision, which is a much more serious allegation than routine mismatch. The court caused the demand because GSTR 2A had been auto-generated, confirming the transaction, and the department simply hadn't bothered to check whether the seller had actually filed GSTR 1 and 3B before jumping into the allegation of fraud. Then in October 2025, last year, the Supreme Court decided Shanti Kiran, India judgment. I want to flag clearly that this is a Delhi VAT case. However, the principles can be still adopted in GST. So it is a persuasive judgment rather than a binding authority on us. But the reasoning is more important. It affirms the read down doctrine from on-quest merchandising. A bona fide purchaser who had paid the seller that was validly registered at the time of transaction cannot be denied credit just because the seller was deregistered afterwards. Courts have been importing this VAT era reasoning into GST disputes on Section 16 subclause Section 16(2) subclause C, given how structurally similar the provisions are. But it's worth being precise with the clients that the persuasive value, not a GST holding. And finally, the one I'm most significant for where this is heading, prime metals versus CBIC. The petitioner directly challenged Section 16 subclause 2 C as unconstitutional along with the specific show cause notice and order. The Rajasthan High Court dismissed the writ in April this year on the ground that statutory appeal was available, a purely procedural disposal, not a ruling on the merits of the wire's challenge. The petitioner then went to the Supreme Court in May, just last 2 months ago. The Supreme Court permitted the appeal to be filed with necessary pre-deposit and critically expressed and recorded the question of Section 16 subclause 2 validity remains open to be agitated before the appropriate forum. So as of today, the constitutional validity of Section 16 subclause 2 C, the very provision at the heart of the Suncraft and Bethel line of cases, is still technically an open question working its way through the system. I would expect a resolution soon, but it's worth watching, especially when the live dispute turning that clause. This slide draws straight from what I see in practice across MSME and franchisee clients. 8 recurring mistakes, one claiming ITC before it shows in GSTR 2B since January 2022, that credit simply isn't legally available yet. No matter how confident you are, supplier will eventually file. 2, zero vendor due diligence. Onboarding a supplier without even checking their GST filing track record, which is exactly the fact pattern behind cases like Suncraft and Bethel. 3, missed 180 days reversal. Nobody in the accounts team is tracking the payment clock supplier by supplier. So it surfaces for the first time during departmental audit with interest already accrued. 4th, GSTR 9 trap I mentioned. Filing your annual return early and unknowingly slamming the Section 16(4) window shut before 30th November. 5th, skipping the annual rule 42 and 43 true up for common credits. This is quietly blinds an interest liability that nobody noticed until a large number. 6, inadvertent block credit claims. A growing MSME buys a company car, builds a new office, or gives club membership to a director and claims ITC without checking Section 17 subclause 5. First, 7, documentation gaps. When challenged, you need to give actual proof, receipt, that is e-way bills, delivery challans, a clean payment trail, genuine transactions, have been denied credit simply for lack of paperwork. 8th, the mention of this. I mention this because half of the room may not have followed it up on it. Generally eligible legacy claims from 2017 to 2021 period denied years ago purely on limitation grounds, setting up revisited, even though Section 16(5) may have now rescue for these all rejected claims of ITC. If you have had an old dispute in the bracket, go and check. This is a slide that I want everyone to screenshot right now. Business owners especially, 10 checks in order you should run them. Every single time before you rely on input tax credit. I won't read every line since it is on the screen, but I'll flag sequencing logic. First, 5 map directly to Section 16(2). Conditions were discussed. Conditions we discussed: invoice, receipt, GSTR 2B reflection, supplier tax payment, and your own return filing. Then Rule 37, 180 days payment check. Then Section 17(5), block credit screen. Then Section 16(4), time limit window. remembering that Section 16.5 and Section 16.6 may rescue an old 2017 to 2021 claim. And finally, the two housekeeping items that quietly cost people money, the annual Rule 42 and 43 reconciliation and complete documentation. If your accounts or compliance team runs through this list as standard operating procedure before every ITC claim, or even just monthly as a health check, you will eliminate the vast majority of ITC disputes before they even start. Let's close the substantive part with where this is all heading. The simple biggest structural development is that the GST Appellate Tribunal has finally become operational on 16th February 2026 this year, after being on paper since 2017, but non-functional for 8 years. Principal bench is situated in Delhi and several state benches, Kolkata, Hyderabad, Cuttack, Ghaziabad, have become operational and are now hearing cases. There's one time transitional window. If your appellate order was communicated before 1st May 2026, you have time until 31st July to file an appeal before GSTAT. This is extended deadline from 1st April this year. The principal bench also doubles up as a national appellate authority for advance ruling, which should finally bring some consistency to the conflicting state level advance ruling we all have had to deal with. And practically, high courts are now far less willing to entertain writ petitions where GSTAT route is available. So litigation strategy needs to be adapt on that. On automation side, GST and invoice management system, IMS, is a genuine shift. It lets you accept, reject, and keep pending each inward invoice in near real time, rather than waiting for return cycle. My advice, build a weekly habit to reconcile through IMS, not a monthly or quarterly one. Behind the scenes, the department is also increasingly using AI-driven risk scoring to flag mismatches and triggers. Rule 86A blocking, which means having a clean, verified vendor data and isn't a just good for bookkeeping anymore. It is an active risk management. My concentrate is to ask everyone in this room, build a monthly ITC health check into your SOP. Keep the checklist I just showed you. And if they have an old list, that needs to be changed now. This is a bonus slide. I know a number of you in the audience are franchisee operators and growing SME or MSME. And business restructuring questions come up constantly. If I merge two entities or spin off a division, what happens to the ITC sitting in my credit ledger? The short answer, it doesn't die. But you must follow the right form. Rule 41 covers sale, merger, demerger, amalgamation, lease, or transfer of a business. You file Form ITC 02 electronically, and the unutilized ITC in your electronic credit ledgers transfers to the transferee. For demerger specifically, the credit is appropriated based on the ratio of assets values of new units, as laid down in demerger scheme itself. One thing people often forget, you need a chartered accountant or a cost accountant certificate confirming that the transaction specifically provides for transfer of liabilities. Without that certificate, the transfer is incomplete. And the transferee has to actively accept the details on portal before the credit lands in their ledger. Rule 41A is a narrower and more specific to franchisee style operation. It applies when business takes a separate GST registration for an additional place of business within the same state. Under Rule 11, if you want to move part of your existing unutilized credit to the new GST registration, you file Form ITC 02A within 30 days of getting the new registration. And the transfer happens in the ratio of assets values held by each registered place. I have marked this as a bonus time permitting topic since it is a bit more specialized than the core rights and restrictions material. But if you have any actively planning a restructuring or a new branch registration, do come forward and find me in the Q&A session. 5 things to remember. Let me leave you with 5 things and then I'll hand it back to the questions. One, ITC is a conditional right, not an automatic entitlement. All 4 section 16 do conditions plus the GSTR to be matching requirement having to hold together simultaneously. 2, since January 2022, your credit is only as good as your vendor compliance discipline. So vendor due diligence is now a genuine financial control, not a paperwork. 3, section 16.4 deadlines is real and unforgiving, but the new section 16.5 and section 16.6 may genuinely rescue the old ITC of pertaining to financial year 2017 to 21, which were lost purely on the limitation and technical grounds. Go check your old files for this. 4th, the courts have consistently protected the bona fide buyers from a supplier's default, as we saw in the Suncraft and Bethel case. But the protection evaporates completely the moment there's evidence of collusion or fake invoicing change. 5th, the GSTAT is finally operational after 8 years. Legacy disputes have real functioning forum again. Don't let a winnable old claim quietly lapse. If there's one line I would want you to take away with is, this is a credit that follows with discipline, not the other way around. Treat ITC as something you actively earn and defend through good compliance hygiene, not something you passively assume. My contact details are on the screen. I'm always happy to take specific questions afterwards. Well, thank you, and I'll hand it back to Akshay.
Thank you. Thank you very much, sir, for your detailed presentation. And dear participant, we will share the presentation after the session with you, after the speaker approval through email. So you can easily get the contact detail of our speakers in that, and you can ask your detailed queries with them through email or through call. Now, I would like to invite our next speaker, Mr. Shashi Matthew, partner CMS Indus Law. Welcome, sir.
Thanks, Akshat. A very good evening to everyone. I will just set up the slide. Okay, so thanks, Pratik, actually, for the discussion that you took. In fact, some of your topics and some of my topics are also going to overlap. But hopefully, together, we will be able to solve a lot of issues for the larger crowd and the members present today. So before I get into So before I actually get into the litigation issue and what are the different types of cases that we have seen historically, I just want to take you through where we are at 9 years of GST. As we all know, it's a unified tax regime and it has replaced a lot of earlier indirect taxes that were there. As a result, GST collections have actually tripled. And a very important thing that the government of India has been trying for many years, both at the direct tax level and at the indirect tax level, is to increase the taxpayer base. Because as a country and as an economy, our taxpayer base is actually pretty small as opposed to or in comparison to different developing nations and even developed nations. So that is something that really speaking that GST has brought forward is that more people have entered the tax paying capacity. Then, as we all know, and this is a double-edged sword, GST compliance is largely digital. Initially, for many years, in fact, we had teething problems in the first 2-3 years on transitional credit. And as we all know that eventually courts had to step in and support the industry, support businesses either through manual filing or by allowing the GSTN portal to be opened for a larger period of time. Now, of course, being largely digital, it has really helped not only in terms of compliance, but also for the department to to do the tax administration properly. We are seeing AI-based and intelligence-led data being fed to the government. The government has a dashboard across all departments. So whether it be the income tax department, the DGFT, the GST department, the customs department, a snapshot is available to all of these authorities at one point of time, and therefore they are able to do risk-based interventions at the right time. So now, of course, the focus has shifted from implementation to certainty. We have enough judgments now giving a direction not only to the government but also to industry on how certain issues should be looked at. And that's what we will go into in the next few slides. Over the next 20 odd minutes, I will take you through some of the cases that have happened in the past, how they will continue to affect you, and also some of the teething issues that we have seen in the GST appellate tribunal system, which has come after a long time, almost after 8 years of GST being launched. We finally saw the GST appellate tribunal taking shape. But as the deadline got closer, we noticed a lot of issues. And by virtue of this platform, I want to show all our members how we have been able to navigate that, and hopefully that will be of help to you as well. So these are some of the litigation areas which we have seen over the last 9 years. As part of this presentation, we are not going to go through all of these topics. Some issues like transitional credit are already done. Some are pending before the GST appellate tribunal. And a lot of these issues are known to the industry. So we won't delve into each of these issues, but we will only look at the highlight issues. So as in fact, as Prateek had covered earlier, this is one of the main issues that is there, that ITC denial due to supplier side defaults. So while Prateek has covered both Suncraft and Bethel Enterprises, and I will not get into that because the audience has already had the benefit of that. Let's understand what these issues where these issues actually come up from. These issues happen when suppliers fail to deposit tax with the government or don't file the return or report invoice details incorrectly. Some of these issues will get solved with the IMS kicking off fully. Some of these issues will continue, and that's a structural problem that GST has. And that is what courts have repeatedly held. That the position is that if I have paid my supplier for the supply, I shouldn't be penalized for something that it's actually beyond my control. And therefore, the government had to introduce 16(2)AA to ensure that GSTR 2B should be the basis of taking the credit. But of course, that has increased the compliance burden on recipients. One thing that we always advise our clients, and we continue to advise, that there should be a linkage, and we are talking about contracts which are negotiated, or even standard form contracts. There should be a checklist built into the a balance mechanism built into the contract itself. We have advised clients in the past that if the returns for the previous month has not been filed, or if you see that your vendor is someone who regularly delays on making GSTR 3B filings or reporting it, this has to be a condition in the contract itself. And that hopefully should resolve a lot of issues for MSMEs and even for large companies who are negotiating contracts, that the previous month's filing should be clear. And as tax professionals, that's something that we are also advising to clients. Of course, the option of going to court is there, but even in that, as Prateek also mentioned, it comes with a caution that if there is a collusion between the supplier and the recipient, and the department is aware of that, then even going to court will not help. All of the judgments which have come till now have created a balance between protecting the revenue and the rights of taxpayers who actually genuinely paid their vendors, and therefore they should not be penalized. And that is something that comes from Arise India, from OnQuest, and even post the GST coming in, courts have continued to hold that jurisprudence strong. So, at least from a paperwork perspective, from a compliance perspective, if that is kept solid, then it will help you even if you have to go to a writ court for getting benefit from them ultimately. One should also remember that these are statutory restrictions, and therefore at the OIO stage, that is at the commissioner stage or the commissioner appeal stage, or even the GST appellate tribunal stage, these issues will not be, you cannot find relief from these authorities because these are statutory authorities. Being statutory authorities, they have to follow the line laid down by the statute, as opposed to a writ court, which has a slightly larger jurisdiction. Again, this is something that is an issue that we are seeing lately, which is on account of retrospective cancellation of supplier registration. This issue comes up because when you entered into a transaction, when you purchased goods from your supplier, the supplier was genuine. I'm sure as industry participants, as people in the accounts department or in the tax department, you would have gone back and done a KYC on your customer, or at least done some sort of verification of the customer. Those documents should be kept with you to show that at the time of entering into the transaction, you have entered into a transaction with a legitimate supplier, with a vendor who was registered with the department and who was also filing returns regularly. This is information which is available in the public domain, so it's not really something that is out of the books. So once you have done that, then you have a genuine case to prove before the court and before the tax authorities that, as far as I am concerned, during the relevant period of time, I have entered into a transaction with a genuine person. If his registration was cancelled subsequently, even if it was done with a retrospective effect, that should not be a ground for denying me the benefit of ITC. And there are enough number of decisions on this. Also, there are contrary decisions where where the transactions have been entered into after the GST registration was cancelled, or something, or where there was actual collusion between both parties. So documentary evidences should be strong. Now that we have the e-invoice system, this is something that going forward, it will be easier to prove to the government and to the tax department. Next, on provisional attachment of property and bank account. So while the section does provide that your provisional attachment cannot go on beyond a period of 1 year, and while these judgments which are present on the screen do say that it is an automatic lapse, they cease to have effect, there are still cases where provisional attachments are being challenged before the court, either before the expiry of 1 year or after the expiry of 1 year also, even though judgments including Supreme Court says that you do not have the power to issue another provisional attachment or extend or reissue a lapsed attachment. We have seen that tax department still does that. Now, the problem with provisional attachment is that because it is used under Section 83, it is merely a notice which goes to the bank, and the bank has to follow the notice which has come from the GST department. So they straight away block the access to the bank account, and also a debit freeze. What happens is, we have seen overreach by the tax department, that even if the probable demand that could be there is lower than the amount that is there in the bank account, a bank account attachment means a debit freeze on the entire amount that is there in the bank account. As a result, you have strict business disruption that happens. You're not able to pay salaries or pay vendors. That is the time when you actually have to step up and go to the court. 83 is not to be used as a routine measure, is something that courts have repeatedly held. and that is because it affects business operations, and therefore reason to believe is something that should be found in the attachment order itself. If not, that is something that can be challenged before the court. And as we said, 83 itself says that it's a fixed life of 1 year, and therefore it cannot go beyond that period of 1 year. So in such cases, it is advisable to take an opinion from your legal advisor or from your tax advisor, who will be able to examine whether it is a fit case for going to the writ court or not. We then have, this is an interesting issue that actually came up before the Jharkhand High Court. And in fact, we're also seeing this in a lot of orders which have been passed at the time of verification of transitional credit also. The issue here is that a notice under 7374, which is essentially a GST notice, is being issued for denying ITC under the earlier regime. And that is something that the Jharkhand High Court has come down very strictly on, saying that wrongful availment or utilization of ITC under the SENVAT credit regime is to be dealt under that regime and not under 73 of the CGST Act. And that has been also followed in the other case. And in fact, I think Usha Martin has also gone to the Supreme Court, and the Supreme Court has dismissed the SLP on that. So what the courts have said is verification of transitional credit is completely distinct. So this is just a numerical verification. Once you are eligible for SENVAT or VAT credit under the erstwhile law, you are automatically eligible for it under the terms of Section 140. As long as you fall within Section 140, you are eligible for taking that credit. But if you have, one has to dispute that SENVAT credit has been taken wrongly, the correct process for that is under the earlier regime and not under the GST law, is what courts have held. Therefore, recovery cannot be done under 73, and you have to go back to the earlier law and issue a show cause notice from there. Now we'll come to certain practical. So this was so far what we have seen is the what I would call the leading issues that have happened in the past and continue to happen. Now we look at certain issues that could arise in the future. So while we are still at the stage of GST Appellate Tribunal, and the GST Appellate Tribunal, though it is not fully functional, there are a lot of judgments which have come from the GST Appellate Tribunal. Now, what happens next? Now, if the order of the GST Appellate Tribunal is passed by the state tribunal, then the appeal goes to the High Court. If it is by the principal bench, it will go to the Supreme Court. Now, while we are used to a mandatory pre-deposit and therefore a stay on the demand for that particular period, akin to the earlier regime, we will now have to, when we go and file an appeal before the High Court or the Supreme Court, it will have to be filed with a stay application. And that is because if there is no automatic stay because there is no pre-deposit. Because there is no pre-deposit, you're opening yourself to coercive action. Now, while this is similar to what the previous regime had, the problem that we do envisage will happen is that because the wordings of Section 119 is such, it becomes automatic payment, or rather, the department may move in for coercive action immediately after the GST 80's order. In such situations, it is important for us to communicate with the department and inform them of settled law. Enough number of judgments, both High Courts and Supreme Court has also held that until the period of appellate remedy is available and is not exhausted, the department should not move in for recovery. So there are two judgments that we have put out on the screen. And there are other judgments also which follow the same line, that as long as I have my appellate remedy limitation is available with me, within that period, the department should not step up and take coercive action. Of course, once an appeal is filed before the High Court or the Supreme Court, it should be filed with a stay application. And if the stay application is rejected, then you are opening yourself to coercive action. And therefore, at the time of filing stay application, the stay application should not be treated as a routine application. There should be strong grounds on why there is a prima facie case. why there is a balance of convenience, and why there won't be any loss to the department if a stay is provided to the SSE. Now, this is something older professionals and also older tax professionals and older professionals in the industry would be aware of, that prior to 2014, there was a system before the tribunal where, along with your appeal, you would file a stay application. And a lot of focus used to go into arguing that stay application for the interim relief. So while we are away from that for 12 years now, but we should still be aware that there are enough number of jurisprudence on why stay should be granted and why interim relief should be granted to protect the SSE from coercive action. Next is, we have recently seen cases where SSEs are going to High Court and seeking the writ jurisdiction of the High Court on the ground that pre-deposit amounts are substantial, and therefore that they are taking the route of a writ petition to avoid paying the pre-deposit. Let me caution everyone that when you have an alternate remedy, writ petition is not advisable, because it is the discretion of the High Court to entertain a writ petition. There are judgments of the Supreme Court which have laid down principles on the basis of which High Courts can exercise their discretion or should exercise their discretion. Of course, that being that jurisdictional issues are there, natural justice is being violated, or there is a constitutional challenge, as tribunals or an authority cannot decide a constitutional challenge, and that is entirely within the domain of the High Court or the Supreme Court under 226 or under 32. Those are the grounds on which you should approach the High Court for exercising writ jurisdiction. Financial hardships is something that the High Court looks down upon and does not allow, and many times we have seen High Courts have rejected writ petitions on this ground, that simply because there is a financial hardship, that should not be the ground for coming to the court. Jurisdictional issues, whether the authority passing the order has the jurisdiction to pass such an order or not, natural justice violations, these are the cases where High Courts normally entertain writ petitions. Of course, there's also the other issue that now that the GST appellate tribunal is there, High Courts will not entertain writ petitions that easily, and therefore there should be a very strong ground, especially following the lines of Whirlpool judgment of the Supreme Court, on which the SSE can go and ask for the writ jurisdiction of the High Court. As I mentioned earlier on in my presentation, this is something that this is more from a practical experience that we have seen. Most importantly, GST 80 is the final fact-finding forum under the GST law. And there are enough number of judgments of the Supreme Court which says that tribunals are the final fact-finding forum, and all evidence, all factual evidence should be placed finally before the GST appellate tribunal. If you're not able to place it before at the OIO stage or at the OIA stage, an application can be moved before the GST 80 to get this evidence on record. One should note that any appeal to the High Court or the Supreme Court is on substantial questions of law and not on factual issues. Now, coming to the portal issues that we have seen, and I'm sure my co-panelists who are also GST professionals, members of the audience who are also dealing with these issues, I'm sure you have seen these issues which are coming up. We just thought it's better to highlight on how to navigate this issue. If there are other issues that you're facing, we would be happy to take it up on the Q&A portal itself. So the first issue, of course, is, and this is very widespread, I think we've done about 45 appeals till now, and this is a standard issue that we are facing in all these appeals, is that the auto-generated APL 05 normally displays incorrect information. And I think in our experience, we have not seen even a single APL 05 which is actually correct. So what you do in such a situation is get it manually signed, corrected, get it manually filed. It should be corrected, signed and stamped by your client or by the SSE, whoever is filing it. And that should be uploaded in the document section. Then where ARN or CRN is being incorrectly auto-populated, there also option is to check to use the drop-down menu of not available and manually enter the details. Again, there are stages. There is a stage where pre-deposit requirement is shown, even where it is not required. So, say it's a refund case, or say it is a case where it is wrongly being shown, or if certain amounts have been deposited at the stage of investigation. In those cases, one should upload a declaration explaining why pre-deposit is not payable. Similar to APL 05, as I discussed in the first point, if the authorized signatory information is coming incorrectly, then please correct it manually, so that at least what you are uploading, and it's a document which is executed at your end, what you are uploading manually is correct, and this can be shown to the registry or to the bench if at all there is a defect that is being pointed out. I'm sure everybody is aware that until 31st December 2026, the GST-80 registry across the country have been directed to keep the scrutiny minimal and to allow, at least unless it is a stark issue that is being pointed out, minor issues, minor technical infractions should be avoided, and don't hold up the filing or the registering of that appeal on that basis. Again, if we have, on 30th June, a lot of professionals did highlight that the portal was facing a lot of glitches. While the Honorable Finance Minister and the CBIC has extended the time, it is in our own experience, we did start filing appeals well in advance, and wherever there were problems, this is where we have actually followed. This is the process that we have followed for rectifying this issue. For our members of ISFA who are in Delhi, I can tell you that we have had phenomenal success with the support that the GST-80 bench gave us in Delhi. And there were enough officials there. We had discussions with the assistant registrar also, pointing out what are the problems that the assessees have and what are the issues with the issues that we are facing. And to a large extent, these have been solved also. So, of course, like every other IT issue that we have, you have to raise a grievance or a ticket. In this case, it is done on the GST-80 portal. While it is a slow process, if you have already been able to get it resolved, it's fine. Otherwise, using the ticket reference number, you can follow up by email. Thereafter, the other option is to contact the help desk, and we've also had some amount of success, even as professionals at our level. Our GST-80 logins, we've had issues. So we've reached out to the GST-80 help desk. We've reached out to officials from NIC to resolve these issues. So to the larger audience, all that I would say is that these are options available to you, and you should be able to use this and get a resolution to your problems. Again, as I said, we will take questions at the end of the webinar. These are our details. Thank you all, and thank you to ISFA for having us on board.
Thank you, sir. Thank you very much for your presentation. Now I would like to invite our next speaker, Mr. Brijesh Kothari. Sir, over to you.
Thank you, Mr. Akshat. I hope the screen is visible.
Yes, sir.
Okay. Good afternoon, ladies and gentlemen. Now cover the last part of the discussions on some of the benefits that are available, particularly to the MSME sector. So as we are aware, GST has completed 9 years. And at this stage, it is imperative for us to look back as to what are the benefits that the law generally provides for and where we are missing out on. And that will be the central focal point around this discussion. So we'll be covering the overall discussion in 3 parts. First being the benefits that are available. Second, particularly for the exporting community. Second is the interplay between the customs and the GST law, where MSME has some relevance from GST perspective. And next point again being the global trade reality based on the tariff that is imposed by US. So this is the agenda for today's discussion in this part of the session. So when it comes to sorry, just one second. Yeah, so when it comes to the benefit that is available for the MSME community, as we are aware, when we export goods, these are treated as zero-rated supplies, and ideally these should not be subjected to any tax. And as exporters of goods and services, we have two options. One is to export under the cover of LUT, and second is to export without payment of taxes. So generally, the refund is available within a short span of time, and refund generally gets processed within a period of 7 days, where provisionally 90% of the refund is granted immediately. So like what we discussed, there are two options. One is to export goods or services under the cover of LUT, and second is IGST, that is export on payment of taxes. So we'll cover these two options. First being the LUT route. Generally, it is recommended for MSMEs because it does not involve tax payment upfront. And the process is also a little streamlined with the refund application being made available online on the GST portal itself. So it requires furnishing of a letter of undertaking during every financial year. And based on the refund that is eligible for export of goods or services, the applicant is required to file an application on the portal for claiming refund, that is form RFD01. So one benefit available in this scenario is that we don't have to pay taxes as we export goods or services. Whatever ITC that has been accumulated on account of export of goods or services can be claimed as refund by filing a simple form on the portal. So this is a very simplified way where there's no impact on MSME on account of blocking of working capital. And one important point to note here is it requires filing of the letter of undertaking or LUT on the portal at the beginning of every financial year. And as and when the exports are made, the application for refund in RFD01 has to be filed on the portal itself. The other option that is available is to export on payment of taxes, though this is simplified in terms of how the information flows on the portal, but it requires payment of taxes upfront. For example, if we export goods or services worth ₹100, it requires payment of 18 rupees over and above. For example, if the rate of tax is 18%, it requires payment of tax along with at the time of export of goods or services, and the same amount can be claimed as refund based on the information that is furnished on the portal. So we'll come to the next step of how this information flows on the GST and portal, how it moves from GST to the customs IceGate portal, and how the refund gets processed. So the key point to note here is if we opt for LUT route, it helps us to free up the working capital, and also it helps particularly for the MSME because it doesn't block the working capital and it is seamless in terms of the process. So coming back to the IGST refund mechanism, it is a silent killer in a sense that we have to be very careful in the information that is furnished on the portal. Though this is an automated system where once we file the shipping bill and the information flows from the shipping bill data as well as the EGM manifest, and the same is furnished in form GSTR 3B, that is the export related transactions. This gets validated based on the data that is furnished by us at invoice level between GSTR1 and the IceGate. So based on this matching of data at invoice level, based on whatever is furnished in GSTR1 and the IceGate, the shipping bill itself is deemed to be the application for refund. And accordingly, the refund gets processed and is sanctioned seamlessly. Some of the common errors that we generally come across when the exporters opt for this route, that is IGST payment route, is that the information that is declared in the GSTR1, particularly when it comes to the GSTIN of the customers, there is generally a mismatch between what is declared at the invoice and the shipping bill. So I'm talking about the GSTIN of the exporter. For example, if the export is made from, say, state A, and the shipping bill indicates the GSTIN of state B, then these mismatches lead to denial of refund or an error being generated at the time of filing of the refund application. Another issue is the information on the GSTR 3B. Generally, the zero rated supplies are required to be reported in table 3.1B of GSTR 3B, which is for export of goods or services. But some SSCs end up reporting the overall turnover in GSTR 3B at table 3.1A, which is meant for domestic supplies or all the general supplies. So this information not being furnished in GSTR 1, GSTR 3B at table 3.1B does not allow the information to flow from GSTN portal to IceGate portal, as a result of which the refund generally don't get processed. Also, some of the common errors of wrong shipping bill entered in GSTR 1, the shipping line not furnishing or not filing the export general manifest, these leads to non-sanction of refund in cases where we are entitled, but in some cases it get delayed as well. So important action point here is that as and when we export goods or services, it is important to reconcile GSTR 1, particularly table 6A of GSTR 1 with table 3.1B of GSTR 3B. And based on the reconciliation, every month the returns are filed in GSTR 3B without so that there is no room for either delay of refund or rejection of the refund. Coming to the next point on duty drawback. So generally, MSMEs are not aware of how the duty drawback works and what is covered. So basically, duty drawback covers all the non-creditable duties. So prior to GST, it also had imbibed into its rate the basic customs duty rate, as well as either service tax or central excise duty. So generally there are two rates, the all industry rate and the specific rate based on which the refund is sanctioned. That is the all industry rate is considered to be a lower rate, which only factors the BCD component. And generally the exporters who export goods have an option to claim the duty drawback at all industry rate. And they also have an option to file refund simultaneously in respect of the IGST. So when it comes to the refund of IGST, the amount that is entitled is based on the export, as we have seen in the previous slide. That is the IGST component either at the ITC level or the GST charged on the invoice for export of goods. But when it comes to the drawback rate, the all industry rate only covers the basic customs duty portion. So there have been doubts as to whether, because section 54(3), the proviso restricts refund in respect of the transactions where the drawback has been claimed. So there are doubts as to whether if we claim drawback for export of goods, are we entitled for IGST refund or not? So as long as we are claiming refund of the basic customs duty component of the duty on account of export of goods, and simultaneously also claiming IGST refund, there is no problem. And that has been confirmed by Madras High Court as well as Bombay High Courts. So this is something that a lot of MSMEs miss out on. And this is something to be looked into carefully to ensure that we claim all industry rate, which only covers basic custom duty component. And parallelly, since IGST refund is available on the GSTN portal, the same can be claimed without losing out anything. And the important point to note is we need to switch to lower rate of drawback, and the refund for IGST is available without any challenge. Next point on some of the benefits that have been introduced on the GST system based on GST 2.0 that is rolled out from September 2025. So now based on this recent mechanism for allowing provisional refund even for inverted tax structure, the refund compliances have been reduced drastically, and for all the cases, not just for export of goods on payment of taxes, even for IGST refunds, the refund can be taken on a provisional basis within 7 days of its filing. Also, now that we have only two rate that is either 5% or 18%. This has drastically reduced the confusion as to whether the applicable rate of tax for our goods would be 5%, 18%, 28%, or 12% is not a problem that is uh, relevant anymore. And therefore, some of the applicants, depending on what their category of goods or services are, can go for refund at a simplified rate structure. And the refund process time also has been brought down substantially. The average refund processing time is brought down to 7 days, as a result of which the faster refunds help in uh, ensuring that the working capital is not blocked for a longer period. So one point to note here is this benefit is available for tax compliant assessees, and therefore it is imperative to ensure that we file our returns on time, we claim refund without ensuring that there is any mismatch in terms of whatever data we have furnished on the GST and the returns. So these good compliances help us to encash the refund without any delay and reduce the working capital blockage. We now come to the interplay between GST and customs, where MSMEs are impacted. So generally, when we import goods, we pay IGST along with BCD. So generally, the manner in which the computation happens is the accessible value being rupees 100 is subjected to BCD of say rupees 10, and GST is charged on the basic value, that is the accessible value of 100 rupees plus the basic customs duty on 10. So instead of it being calculated on 100 rupees, it is calculated on 110 rupees. But this 110 rupees, 18% is available as excuse me, available as input tax credit in the hands of the importer. So one point to note here is people who operate the MSMEs that operate under the composition scheme are not entitled for the refund, not entitled for the input tax credit on the IGST paid on import, and therefore this is something that has to be factored into consideration when we operate as a under the composition scheme. The input tax credit is not entitled. We are not entitled for the input tax credit, and therefore we should not factor IGST as a non as a creditable tax. Also, another point to note is generally BCD is also taken into consideration for determination of whatever is the GST chargeable on the value. So it is not on 100 rupees, it is on 110 rupees. So this is something that we have to ensure take into consideration when we determine the cost or the sale price of the finished product. So with this, we move to the next part of some of the recent compliance mechanism that MSMEs are required to comply with. For example, when it comes to the invoicing for assessees with turnover of more than 5 crores, every B2B transaction has to be reported through electronic invoice. That is, the invoice has to be reported on the invoice registration portal. And this will ensure that the customers of the our customers are not at loss of input tax credit, because if the invoice is not reported on the GSTN portal, on the invoice registration portal, the recipient is not entitled to claim input tax credit. So this is an important point to note for MSMEs with turnover more than 5 crores. Also, when it comes to supply of goods or movement of goods, wherever the value of goods is more than rupees 50,000, e-way bill is required to be generated mandatorily. And in some cases, for intrastate movement, the threshold is higher, say 1 lakh in some cases. So these threshold have to be kept in mind when we are moving goods to ensure that the goods are not detained and these are not subjected to unnecessary delays and lashes. So considering the requirement of reporting the details of invoices on the invoice registration portal, generating e-way bills, so these are some of the logistics part which have to be taken into consideration when it comes to ensuring compliance, and treating these compliance requirements and in silos generally leads to delays and in some cases even detention of goods. So these are some of the points that we have to be careful and ensure that we don't miss out on these requirements. We come to the last part of the discussion. Before that, we'll just cover on the ongoing discussions between India, US, as well as the recently finalized India-UK trade deals. So when it comes to the India-US arrangement, it is an interim agreement between India and the US. So to give you the background, uh, prior to the introduction of this tariff that was in February 2026, the US had introduced tariff across the globe for many countries, including India, where depending on the trade imbalance, the date of tariff was imposed. India was subjected to a tariff of 25% initially, which was subsequently increased to 50%, the differential tariff being on account of import of Russian crude. And subsequently, in February 2026, two important decisions were made. One is the United States Supreme Court had ruled that the tariff that is imposed under IEEPA, that is International Emergency Economic Powers Act, is not valid, and therefore the president does not have the power to impose tariff based on invocation of IEEPA. And accordingly, the the decision was struck down. Parallelly, India also had entered into an interim agreement with US, wherein it was agreed that import of goods from India would be subjected in US to a tariff rate of 18%. So with this background, some of the industries, particularly pharma, gems and jewels, and aircraft parts, were continuing to be at a lower rate of, or rather a zero rate of duty when the goods were imported from India into the US. So one important point here was that the rules of origin have to be complied with, and wherever the goods were imported into India from US, the exporter had to ensure that the country of origin and the source of goods are clearly declared in the document for export of goods to US. Also, we have the agreed India-UK FTA, wherein the goods imported into UK from India would be subjected to a substantially lower rate of duty, and in some cases, the duty has been brought down to nil. And this is coming into force from 15th of this month. This also requires complete document tracking in terms of the source of goods and ensure that the country of origin rules are met. And therefore, as MSMEs who are exporting goods either to US or to UK, we have to ensure that we have uh, proper invoices for inputs. We have claimed input tax credit at the input stage, and our returns are filed properly with clear documentation to show that the goods are either originating from India and are eligible for concessional rate of duty in that country. And in cases where, for example, if we say goods are imported from China and such goods are subjected to export to the US customer, and the customer, relying on our declaration that the goods are Indian origin, claims a concessional rate of duty of 18% there, then the same may be investigated, and the same may lead to a problem for us when we deal with such customers in future. So like what I mentioned, 2025 IEEPA tariff was increased from 25 to 50%. In February, there was a ruling of Supreme Court wherein by 6-3 majority, it was struck down to say that IEEPA cannot be invoked for authorization of tariffs. And another important recent development is that from April 2026, a CAPE system has been introduced where the US Customs is processing refund wherever the duty of 50% was collected from the US importers. And in some cases, such benefits are even passed on to Indian exporters. So one, from our perspective, the Indian exporters have to be ensuring that wherever such benefits are passed on to the Indian exporters, we accordingly calibrate on whatever benefits we are entitled for, both from the duty drawback as well as from the road tape scheme claims. We also have to take into consideration the price that has to be negotiated going forward. For example, if at present rate, it is at 18%, but prior to, at the time of import, it was at a higher rate of 50%. then we have to calibrate such duty into consideration to determine what our selling price should be and ensure that we are competitive in the market. So while US market is a huge opportunity for the Indian exporters, it has as as the Commerce Minister Piyush Goyal had mentioned that it is a 30 trillion market, and we should not lose out on exporting goods to the US. And therefore, with this Supreme Court judgment of US, we have to be mindful and be interacting with the importers in US to ensure that the benefit that they have claimed on account of it being refunded to them is passed on to us, and we also ensure that such benefit is given proper treatment from GST as well as customs perspective. From GST, in terms of the fact that we are receiving additional consideration, how do we report such amount in our returns, in our financial statements? How do we claim the additional drawback as well as ROTEP on the amount that we received over and above the initial export value? Also, a recent development is that after the Supreme Court judgment of US, where the 50% tariff was struck down from India's perspective, the US government has imposed Section 122 tariff, which is in the range of 10 to 15%. It is basically a balance of payment tool where the balance of payment between two countries, for example, India and US, is high. In such cases, the law allows for imposition of tariff under Section 122. And also, there is an ongoing investigation from US government under Section 301 of the Trade Act. So this is primarily for unfair foreign trade practices, particularly for on allegation that the laborers are not subjected to proper treatment in exporting countries, and on such grounds, the tariff are being imposed from the US for import of goods into US from various countries. So these are ongoing investigations, and it is likely that once the trade deal has been finalized, these investigations or the outcome of these investigations will have a bearing on the effective rate of duty for export of goods from India to the US. And therefore, it is likely that 18%, which is an interim rate for now, may not be the final rate, and it may change based on the outcome of these investigations. So as exporters to US, we have to build flexibility in our pricing, and also to ensure that in case of change in the duty that is resulting out of these investigations, how do we factor our price to the customers in US to ensure that we maintain balance, not just in terms of our eligibility to export goods, but also to ensure that proper reporting compliances are met from customs as well as from GST perspective. So I'll just sum up my discussions from all the 5 points. First, we discussed about us ensuring that we don't lose out on the benefit on account of export of goods or services, and therefore to meet such benefits, or not to lose out on such benefits, we need to ensure that we file LUT every year. If we have not already filed, ensure that it is filed on the GSTN portal online, and also have the benefit of exporting goods or services without payment of tax. Second is, when we export goods, we have to ensure that the data that is furnished on the returns, particularly in Table 6A of GSTR1, matches with Table 3.1B of GSTR3B. This ensures that the refund is processed and sanctioned within the time limit that is prescribed, and it avoids any unnecessary delays and working capital blockages. Another important point is some of the exporting community, particularly in MSME sector, may not be aware that duty drawback benefit is also available. So wherever the benefit is not being availed, it is better that we revisit our products and see what is the entitlement in terms of duty drawback for the customs duty portion. And the same is claimed by ensuring that it is not at a higher rate where the GST component is not factored in when we claim refund, because IGST refund is separately claimed in terms of Section 54 and Rule 89 or 96. Next point, we have to be aware of what is the trade development across the globe, including in US and UK, and understand the functionality of IEEPA and ensure that if the differential duty is refunded to the exporter, how we report such benefits in our returns, in our financial statement, and also reap the benefit on account of the differential rate from duty drawback, from RoDTEP, as well as from by declaring it in the returns without any hazard. Last point, we have to ensure that if we are exporting goods to the countries in US and UK, how we have to properly document the inputs in particular when it comes to establishing that the goods are originating from US, from India, and are entitled for the duty benefit that is eligible in the importing countries. So with this, we come to an end in our discussions. We can maybe move to the question and answer.
Thank you very much, sir, for your detailed presentation. Now I would like to invite all our panelists on the screen. Please switch on your camera. And I hope you all are able to see the questions in a Q&A box. Few of questions you already answered. And I'll just request to all of them, should I read the question or you just read and answer the question? And
Akshay ji, you can read the questions and we can then answer the relevant.
okay. So first I read the question of Shri S.C. Agrawal. Do you have how much GST has been collected for GST on goods and GST on services and for any year?
Sir, I would not answer that query because it's more a statistical data question. We can take up the legal queries here so that all participants can take benefit of it.
Sir, you can reach out to Prateek ji after the session. You can write to him on his email, and maybe, or either you can consult him in his office. So maybe he may be able to answer this question, not in a public forum. Okay. So next question is Mr. Prakash. Sir, we have received payment quarterly due to our terms to issue invoices in quarterly against export of services. Can we refund claim against each month ITC accumulated due to our export of service is exempted with effect on 1st April 2026?
So I can take up this question. So
Okay.
what we understand is that the services that the SSC exports has been exempted from 1/4/2026, and the input tax credit is availed for the period prior to the services getting exempted. And the question is whether we can claim refund for the past period. So while refund for claiming export on account of export is eligible based on the periodical returns that we have to file. That is, for example, if the refund is pertaining to the period, say January to March 2026, then the SSC has an option to file form RFD01 on the portal for that period. And since the exports have been made during the period prior to April 2026, they are entitled for refund for the period up to 2026 April. And ensuring that the refund is not filed after April 2026, because all the services or goods that are procured prior to that period will not be eligible for refund. So the question as to whether individual monthly returns have refund application has to be filed or a consolidated refund application has to be filed. The portal allows for consolidating the refund application for multiple periods, and therefore if the inputs or input services have been procured over a period of time, say for example January to March, they can consolidate all the details for the period January to March and claim a consolidated or single refund application.
Thank you, sir. Next question is Brijesh sir from you. Do we have any case law notification circular or any technical reference which helps us to substantial the same to officer, because currently an enforcement case is going on and we need to substantiate our stand.
So I think this is a question. I'll just give a background. There was a question posed on the Q&A box for a banking company whether Rule 38 is applicable, which allows for input tax credit on 50% of the input services. And when it comes to capital goods, there was a question as to whether we can avail 50% input tax credit and capitalize the balance amount. For example, if the value of capital goods is rupees 1 lakh and the tax charge is rupees 9,000 plus 9,000, and they have availed input tax credit of 50%, that is 4,500 under CGST and 4,500 under SGST. So whether they are entitled to capitalize the balance amount, that is balance 4,500 into 2, along with the value of capital goods, that is 1 lakh. So what they will capitalize is 1 lakh plus 18,000, 9,000. So that is allowed, and there are case laws available to establish. It was a practice that was even followed under central excise regime. The service Senvat credit rule also allowed for availing input tax credit on 50% of for banking and financial institutions. So maybe you can reach out. We'll share the relevant case laws on this aspect.
Thank you, sir. Next question, Pratik sir, from you. Hope this will not be disallowed during audits. Also, cause the physical invoice, which show both item under taxable and non-taxable column. Sir, you are on a mute.
No, so I think this question was answered by me. This is a follow-up question.
Okay.
No, so this, I don't think this will be an issue under audits because your regular invoice can have both taxable and non-taxable. And as far as e-invoicing is concerned, the government has also clarified it's only for taxable supplies. And that is because the law also says that a bill of supply is to be issued for non-taxable supplies.
It is rightly said by Sachiji, and I fully agree with his view.
Shashi, the next question is from you. One
Yeah,
DRC.
so
Okay.
I'll answer this. Basically, this is a limitation issue, and there are enough judgments to say that limitation is a jurisdictional issue, and therefore a writ is definitely an option, but that is entirely dependent on fact pattern. And because it is very strange that the authority has accepted part of the demand to be time barred and part not to be time barred. So we'll have to see. But definitely, if there is an issue of the entire demand being time barred, limitation is something that strikes the root of the jurisdiction of the officer, is what courts have repeatedly held, and therefore a writ can be explored.
So we have answered all our queries. Thank you very much to all our panelists for sharing their valuable insight with our audience. And we will share all the presentation of the session with the thank you mail to all our participants. And I request all the speakers, please answer all the queries which you received on your personal email or WhatsApp, any source, so that the people can get the benefited from this. Thank you very much to all the speaker, all the participant, and special thanks to CMS Indus Law and Sherman Legal for making this session possible, for their support. Thank you very much.
Thank you.
Thank you.
Thank you.